Welcome to our podcast, where today we're challenging common beliefs about escaping poverty in America. We often focus on wages or government support, but sometimes what we think of as assets can actually trap people in financial hardship. To start, can you explain how this paradox plays out?
Absolutely. While assets like education, homes, or savings are traditionally seen as stepping stones to prosperity, under certain conditions, they become liabilities. For example, if acquiring an asset means taking on debt or ongoing maintenance costs, it can drain resources instead of building wealth. This flips our assumptions about upward mobility.
That's a striking point. So, even the very things we encourage people to pursue, classic building blocks of the American dream, might actually be holding them back if they're not approached with caution.
Exactly. It's a nuanced reality. And today, we'll examine 5 such assets: college degrees, homes, cars, consumer goods, and retirement accounts to see how each can become a financial burden instead of a benefit.
Let's dive into the first asset, the 4-year college degree. For decades, higher education has been sold as the surest route to a better life. But is this always true for modern Americans?
Not necessarily. While bachelor's degree holders do earn more on average, this premium varies dramatically depending on field of study, type of institution, and, crucially, the debt required. For instance, a STEM grad might justify a 80-0 loan, but a communications major working retail likely cannot.
That's a sobering reality. Census data even shows that 1 in 6 college grads is underemployed. What are the broader implications when so many graduates can't find work commensurate with their qualifications, yet still face monthly loan payments?
The consequences are profound. Student debt delays savings, home ownership, and even marriage. It can also limit career choices, as graduates are forced to prioritize immediate income over long-term goals. This cycle not only affects individuals, but also the broader economy by reducing consumer spending and mobility.
Given these challenges, why do so many students still opt for expensive degrees? Is it cultural conditioning, or are there viable alternatives being overlooked?
It's largely cultural. We're told from childhood that college is essential, so alternatives like community college, vocational training, or apprenticeships are undervalued. Yet, these paths often involve far less debt and can lead to stable, well-paying jobs sometimes with higher placement rates than traditional degrees.
So, by broadening our definition of success and promoting these alternatives, families could avoid unnecessary debt and still achieve upward mobility. It seems like a key policy and cultural shift is needed here.
Exactly. Encouraging informed decision-making and transparency about outcomes such as earnings by major or debt loads is crucial for empowering individuals to choose the best path for their unique circumstances.
Now, let's move to the second asset, home ownership. For many, owning a home is the ultimate symbol of stability. But what happens when property values drop?
Home equity isn't guaranteed. In cities like Detroit and Cleveland, entire neighborhoods lost value, leaving owners owing more than their homes are worth, a situation called negative equity. This not only erases wealth, but can devastate credit scores and financial security for years.
The 2008 subprime crisis really highlighted these risks. How do ongoing costs like taxes, insurance, and repairs compound the problem for families in declining areas?
These costs continue even as values fall, forcing families to pay more to maintain a depreciating asset. In many cases, foreclosure becomes unavoidable, and families lose both their homes and their financial footing, often with lasting effects on their ability to recover.
Let's turn to another asset: cars. In much of America, owning a vehicle isn't just convenient, it's essential. But how can a car become a trap rather than a ticket to opportunity?
Cars are expensive to buy and maintain. Take a family earning $30,000 a year that buys a $10,000 used car on credit. With loan interest, insurance, fuel, and repairs, they might spend over $5,000 annually, over 15% of their income. A major breakdown could force them into default, risking job loss if they can't commute.
That's a perilous spiral. What options do families have if their car becomes too costly to keep?
Often, they downgrade to even less reliable vehicles or go without, which can mean losing jobs or missing out on better opportunities. In many regions, lacking a car is a serious barrier to employment, creating a cycle that's hard to break without systemic improvements in public transit.
Let's discuss consumer goods appliances, electronics, furniture, often purchased on credit. How do these purchases, which seem manageable at first, turn into long-term financial pitfalls?
Retailers entice buyers with no interest for 18 months deals, but missing a payment or carrying a balance can trigger interest rates of 24-30%. A 600 refrigerator on credit can cost 900 or more after fees. These debts escalate quickly, damaging credit and consuming future income.
And these credit lines are often extended with minimal checks, right? How does that affect families' financial stability?
Correct. Easy access leads to overused small purchases add up, and suddenly a family faces overwhelming bills. This cycle of debt can erode financial security, leading to stress and even multi-generational credit problems if family members share accounts.
Let's shift to retirement accounts. Most people see 401ks and IRAs as prudent investments, but how do hidden fees and risky products undermine their value, especially for ordinary savers?
Many investors pay 1-2% annually in fees, which can cut retirement savings in half over decades. Brokers sometimes steer clients into high-fee products for commissions. Worse, opaque investments can tie up funds or expose savers to market downturns, leaving them with far less than expected upon retirement.
So, what should savers look for to avoid these pitfalls?
Transparency is key. Compare expense ratios, avoid unnecessary annuities, and favor low-fee index funds. It's also wise to question advisors' incentives and ask for clear, written explanations of all costs and risks.
Up to this point, we focus on individual assets. But what about the psychological and social factors? How do cultural narratives and peer pressure contribute to these financial traps?
Human beings crave acceptance and symbols of success. People buy homes, cars, or expensive degrees to fit in or avoid embarrassment, often ignoring long-term consequences. The pressure to keep up with the Joneses can override rational decision-making, especially when marketing exploits these insecurities.
That's a powerful force. So even with all the data, emotional and societal pressures can push families toward risky commitments.
Absolutely. This is why financial education must address not only numbers, but also the psychological drivers behind spending and borrowing, empowering people to make choices aligned with their true interests.
As we look for solutions, policymakers often propose free college, loan forgiveness, or tax credits. Do these interventions address the root problem, or can they sometimes worsen it?
While well-intentioned, such policies may unintentionally subsidize risky choices. For example, government-backed student loans enable more students to take on unsustainable debt. Similarly, homebuyer credits can inflate housing bubbles. Without addressing the underlying incentives and transparency, these measures risk creating cycles of dependency rather than solving poverty.
So, real reform requires more than just financial assistance. It's about changing norms and increasing transparency at every stage.
Precisely. We need cultural and systemic changes, such as better consumer education, clearer disclosures, and policies that reward prudent choices rather than perpetuate risky behaviors.
Given these challenges, what role does financial literacy play in breaking the cycle of asset-induced poverty? Should schools be doing more?
Absolutely. Studies show students who learn about compound interest and budgeting are more likely to avoid high-interest debt and build savings. Yet, many schools neglect practical economics, focusing instead on abstract subjects. Restoring consumer education and critical thinking is essential for equipping future generations to make informed choices.
It sounds like combining personal responsibility with public education reform could provide a path forward. Is there evidence that such approaches can make a difference long-term?
Yes. Financial education, when rigorously implemented, leads to measurable improvements in savings rates and reductions in debt. When individuals and communities understand both the opportunities and risks of different assets, they're better equipped to achieve lasting economic security.
To close, let's talk about redefining prosperity. How can Americans distinguish between true assets that build wealth and liabilities disguised as opportunities?
True assets increase your options and help weather financial storms. Before acquiring anything, be it a degree, home, or investment task about total lifetime costs, potential risks, and alternative paths. Demand transparency from advisors and institutions, and prioritize investments that genuinely enhance productivity, not just appearances.
So, by adopting skepticism, demanding clear information, and focusing on low debt, high return strategies, families can escape the cycle of asset-based poverty.
Exactly. We must teach that wealth is not just what's on a balance sheet, but the ability to adapt, seize opportunity, and live sustainably. By making informed, resilient choices, Americans can reclaim their financial futures and build true prosperity.